What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we are breaking down the basics of a cash secured put. Now, we've made videos about this before, but I feel like it never hurts to go back to the basics here and talk about what it means to do a cash secured put. If you're new to the channel and you have no idea what I'm talking about, this video is for you. So, if you're excited for today's video, as per usual, make sure you like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. So a cash secured put is a basic options trading strategy, and basically what it allows us to do is to basically get into positions for a cheaper price. If you are bullish on a company, you like the company, but you want to own it for a little bit cheaper, and you also want to get paid for it, cash secured puts are for you. And here's how it works, right? I have a couple stocks that are on my watch list that I wouldn't mind doing cash secured puts with, but I'm going to break down the math behind it, the idea behind it, and what it could potentially mean for you. My first company that I'm looking at is Trade Desk. Now, why am I looking at Trade Desk here? Well, Trade Desk for the recent time has been getting absolutely slaughtered as a stock, down 61.28% on the year. Year to date down 58%, 5-year obviously still up, but almost basically flat between the last 5 years here. Ran up as much as to $140. Then it had a huge sell-off because of bad news and to competition with Amazon, and all these different things happened. And Trade Desk has been trading down quite a bit, no pun intended. These are the companies that are not bad to look at cash secured puts for if you are bullish on a company. Now, this is a company that does have a profitable company. They have a positive PE ratio. They don't do a dividend, but they're a pretty big traded company. They're in the S&P 500. They have a buy signal here. The fair value is about $63 right now, according to Morningstar. So, I'm listening to thinking, okay, why not try to think about going into Trade Desk as a result? Well, if you're thinking about this in this case, so here's Trade Desk kind of selling off here. We had a little bit of a bounce here around like the $44-ish mark or so. And it's kind of rallied back to about $46. Now, let's say you want to get into Trade Desk. You still think there's some room to the downside for it to go, though. You're going to go to Trade Desk options. And then what you're going to do is instead of buying an option, which costs you money, you are going to sell an option instead. And you're going to do what's called sell a put option. Basically, this is a contract between you and the buyer. And basically what it's telling me is that, hey, if Trade Desk goes to this strike price, you will pay for my shares. You're going to buy 100 shares of Trade Desk at the strike price that is agreed upon. Again, 100 shares because the options chain is based on 100 shares per contract. All right. So here's what we're looking at. We're looking at Trade Desk here, and a good timeline for cash secured puts is anywhere from like 30 to 60 days usually. So October 24th, you look at October 31st, November 21st, whatever it is you're feeling, you're more than happy to do it that way. But let's say you want to go to October 24th, and you're sitting there saying, if Trade Desk goes to $40 by October 24th, I'll buy 100 shares of it at a certain strike price. Now, and taking a look at options chain here, for example, this is actually, I'm looking at like say $40 a share maybe. Now, the delta here is very, very low, which basically means the probability of it hitting $40 as a strike price is 16.97%. Very, very unlikely to happen here. But if Trade Desk does go to $46 a share, you will then be asked to buy, or not asked, they're not going to say, hey, buddy, come and buy these if you want. You are forced to buy 100 shares at $40 each, which means that it's going to cost you, and if you put this in the order, markets are closed right now, but put this in the order here. You are then going to be asked to put up $4,000 in collateral. Why is that the case? Well, because they need to have the cash there in case you get assigned the shares. Now, that's why it's called a cash secured put. Now, why is this company not a bad one to go into? Well, so take a look at this, right? I mean, again, they were trading at fair value. Morningstar is about $63 a share. Right now, it's in the 40s. So you're still looking at hopefully about even potential, almost 40% return or something like that along the lines of it. But if you're looking at this, right, you could be selling a $41 strike price here, get paid $98 because it's 98 cents per share, and it's 100 shares. You would pay $98, or you would get paid $98 for the chance of buying Trade Desk at $41 a share. So Trade Desk comes down $5 a share. You then get to buy in at a cheaper price, and you get the premium of $98. You keep this premium as a result, which to me is very, very nice. Now, what does that mean? The return you're looking at here, $4,100, you made $98 out of $4,100. You're looking at a little over a 2% return in about 1 month. That's pretty good because, again, if you make about 2% per month over a 12-month period, you're looking at a 24% ROI, which is absolutely amazing, and it beats the average 10% of the S&P 500. So you could sell a cash secure put as a result, which to me I think is very nice. Things you're looking for, things to keep in mind about when you're selling these is make sure there's volume and open interest so you can get in and out of the trade if you need to. Delta, about 0.2 is a very good delta in my opinion. And make sure the bid-ask spread isn't too wide. Because say you get filled at, say, $95, but it's actually worth $98, you actually are already could give yourself a $3 loss. So that's what happens. Now, if Trade Desk doesn't go to $41 by the 24th, you keep the premium and you don't need to buy the shares, which is great. That's amazing. You're being paid almost $100 for the chance to buy Trade Desk at $41. Oh no, I gotta buy it cheaper. Like, who can complain about that kind of return? It's amazing. Another one I'm looking at that I wanted to get into potentially would be Target. Target's a good one here as well because as we take a look at Target, Target is being getting absolutely slaughtered, down 36% year to date here. Hopefully going to be finding a bottom at some point, but it just keeps selling down and down and down. So I'm waiting to see an actual bounce, kind of like this had right here, a little bit of a bounce and recovery period here. And then on the 1 year, down 44% almost. On the 5 year, down 42%. But a lot of people know Target. They go there. Their dividend is very, very nice. They have a 5% dividend yield. PE is super low. And they're a very, very large company. Morningstar values it at 123. It's at $80-something. You're looking at, again, almost a 40-50% return on Target if it even goes back to that fair value. Or even it goes to $100. If it's at $86, it goes to $100. You made $14 on every share you bought, which to me is absolutely amazing. So you go to trade the Target options. You want to go down to, say, October 24th right here. You go to sell a put option just like so. And then say you want to go down, to, I don't know, what's a good return? About 2%. You're looking at about $83 here. Delta's a little bit higher, so it's a little bit more of a riskier play, quote unquote. But you're getting about a 2% return in the month just for this trade here. Now, as you will see, the bid-ask spread is a little bit wider compared to Trade Desk. So you might get filled at a little bit cheaper than what you're hoping for, which we don't want. So keep that in mind. I always say when the bid and ask spread are pretty wide, set a limit order and let it get filled itself. Don't force yourself into the lower bids because then you lose money before you even start the trade, which we do not want to have happen. But again, if Target goes down to $83 a share, you still get to buy $83 per share for Target, so $8,300 total, and you still keep $163. Nothing wrong with that. It's amazing. It's great. It's phenomenal. Another one I like is Dollar General. Dollar General has been doing the same thing. Dollar General's been getting a little bit of the whack, so to speak. Actually up 33% at the time of the year here. But if you take a look at where we used to be at, go back to the 5 year, it is down 50% over the last 5 years. And I think Dollar General is a company that everybody goes to. It's got cheap food, cheap utensils, cheap this, cheap that. If we're having, if our bills are becoming too expensive and groceries are too much, then Dollar General is the way to go. So, dividend yield 2.31%, PE of 18.89, not too bad. And again, what you could do, taking a look and see what the fair value is on Morningstar. I wouldn't go off of this only, but $117 is fair value. Right now, it's at what, 101? $101 a share. So you got another $16 upside, about a 16% return according to Morningstar fair value. Trade options, sell, put option, go about 30 days out here. Bing, bang, boom. Say you want to go down to, what's a good return we're looking at here? Say you want to go to, I'm looking for about a 2% return. The $98 strike price, 31 delta, not too bad. Bid ask a little bit wide, so be careful of that one. But again, still a little over a 2% return here as a result. And you get Dollar General at $98. That's a steal for Dollar General in comparison to what it's been trading at before. It was over 200 at one point. You're at $98. Like, why not? Last one I've got on my watch list that I'll be looking at is UPS. UPS is a very similar idea. UPS has been getting absolutely slaughtered, down 33% for the year, down 35% for the 1 year, down 47% for the 5 year. And again, was trading as high as $220. Very good PE ratio, very high dividend yield, very big company of $71 billion. Everybody knows UPS as we know it. Fair value 118 right now. Right now it's trading at 84. Trade options, get in at a cheaper price, but while you're waiting to get filled and buy cheaper, why not sell an option? What's 2%? $82. So target comes down to say $82 a share. It comes down to another 2.5%. You get 2.5% discount on your shares, and you get paid premium up front as well. Can't complain about it. So that is what cash secured puts do. And what they do is they allow you to get into positions for not only a cheaper share price, but also they pay you for it. It's passive income. If the strikes don't hit, you keep the premium and you just do it again. You do it again and do it again. So that is how a cash secured put works. Those are my 4 stocks that I'm looking at right now. Thank you guys so much for watching. If you did make this far in the video, feel free to like the video, subscribe to the channel, and turn on those bell notifications as per usual. I hope you're making money in the market in some way, shape, or form, whether it's through cash secured puts or through buying shares, whatever it is. And as always, I will catch you guys in the next video.